An annual report is a document that publicly traded companies provide to their shareholders on a yearly basis. It's required by law, it's filed at the end of a financial year, and the document prescribes the company's operations, its performance, and its financial position in a detailed manner. In fact, Warren Buffett explained it well when he said,
I really like to I like to know as much as I can about the person that's running it and how they think about the business and what's really going on in the business. In other words, I would like to have a report that would be identical to what if I owned half of a company but was away for a year and I had a partner who owned the other half. When I came back, that he would tell me about what had taken place during the past year and what he foresaw coming up and all of that. That is what I think the purpose of the report is.
So the annual report is like a report card, and like many report cards, it's not a very easy document to read. But fortunately, one doesn't have to read all 200, 300 pages of it. And in this video, I shall explain which parts are more important, what is the information that really matters, how much time should one spend on it, and I'll also take you through an example for better clarity. If you find value in this video, then do subscribe to my channel and also press the like button, as it will definitely help me with the YouTube algorithm. Let's begin. Most annual reports follow a similar structure, and these can be broken down into 4 parts: corporate information, management communication, statutory reports, and of course the financial statements. Let's start with the first part, corporate information. And as we discuss this, I shall be using parts of the FY22 annual report of Avenue Supermarts for better clarity. So the section on corporate information includes details about the company, and understandably, it includes a lot of information such as the company's history, its vision and mission, the company's geographical presence, plant locations, or in the case of DMart, where the DMart stores are located, the company's corporate social responsibility initiatives, the major product categories including their revenue and profit contribution, and of course the key performance indicators. Now notice here, these KPIs are primarily financial metrics, and the problem with ratios and measurements is that one can interpret it in many ways. I mean, we did see a problem with Reliance Industries, but I've also seen companies use their own definition of EBITDA, PAT, fixed asset turnover, etc., which is something investors like us have to be careful of. Of course, not every KPI is important, and investors should focus more on KPIs that are specific to that industry. For instance, in the case of a retailer like DMart, the key metrics include the inventory turnover, and the higher this number, the better it is. Secondly, one should look at the revenue per square foot, and again, higher is better. And a third KPI is the like-for-like growth rate, which explains sales growth in the same set of stores as compared to a year or 2 years or 3 years prior. I should also point out that unlike other companies, Avenue Supermart's business falls under a single segment called retail, which is a bit odd for a 200,000 crore company. On the other hand, companies like ITC participate in a number of businesses, and by law they are required to report segment-wise numbers. That is revenue per segment, whether it is cigarettes or hotels or paper or their FMCG business. And not just revenue, ITC Limited also has to report segment-wise profits, assets, liabilities, and even capital expenditure. In fact, a comparison of the capex makes for an interesting reading, as we see over 50% of ITC's capital expenditure going towards its paper business, which is giving them a little under 10% of the profits. So it's a question of capital allocation that the investor needs to find answers to, and it's only when one examines the annual report can he or she even arrive at questions like these. Okay, the next stub of information pertains to who's managing the business, how is it being managed structurally, and what are those managers saying. This part often starts with a message or letter from the chairman or the managing director, who gives a bird's eye view of the company's milestone, the economic and business outlook, the challenges faced by the business, etc. In some annual reports, you might also get a note from the CFO and also the board of directors, which can give us a very different perspective of the business. Now, speaking of the board of directors, and as cheerful this picture is, it's important for an investor to understand who comprises the board. After all, the board represents the shareholders of the company and is supposed to govern the company's management. So as investors, we are looking for a board which has an ideal size, which in my view should be between 8 and 10, a balance of executive and non-executive directors, ideally 50% of each. A majority of the directors should be independent outsiders, that is, they should be experienced business leaders who have no direct connection to the company. And finally, the MD or CEO of the company and the chairman of the board should be two separate individuals, as it improves governance and reduces conflict of interest. Now, if the board is so important, then there is no need to second guess the criticality of having a strong senior management team. And the annual report will provide information on the CEO, the CFO, the sales head, the COO, and other senior members of the company, which are collectively called the KMP or the key managerial personnel. In addition to who they are, annual reports in many cases will provide additional information on their qualification, time with the company, shares held, remuneration, etc., which is a great way for the shareholders to gauge the management's commitment and moral fiber towards the company. And this brings us to the most important part of this section, which is the MD and A section, or the section on management discussion and analysis. So the MD and A is like an executive summary where the management puts together an overview of the economy and the industry, an overview of its own business, and in DMart's case, it will talk about the number of stores, its target market, value proposition, etc. A good MD&A also explains the company's growth engine, how it is building additional capacity, its capex requirements, etc. Then there are the company's key milestones and financial ratios, which is then capped by a listing of the major risks that the business faces. To further narrow it down, I would request all investors to put extra focus on the growth drivers of the company and the risks that the company faces. Why growth and risk? That's because all this information that we are reading here has to be ideally quantified, which happens via a discounted cash flow model, which is something I briefly talked about in a previous video. So the main parts of a DCF are growth, which helps us determine the cash flows, and of course risk, which determines the discount or the hurdle rate. Now, I also said the MD&A is an executive summary, but this doesn't mean it has to be a 1-page or a 2-page document. In fact, I've seen some MD&A reports that go as high as 25 pages, but honestly, I've never found an MD&A to be a boring document. On the contrary, I would say everything that's there in the MD&A should be given some weightage in an investor's analysis of the company, and that's because this section is one of the most read parts of the annual report, which means the management will take extra care with whatever is written there, much like how a political party releases its election manifesto. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips, and stories that I continually post in the community section. Statutory reporting is the mandatory submission of certain financial and non-financial information as prescribed by the law and regulatory bodies. Now, the annual report consists of a number of statutory reports, with each of them serving a different purpose to us as investors. The first one is the director's report, which in addition to financial information also gives us the important nitty-gritties of the business. This includes things like the credit rating, changes in share capital, how the proceeds from a rights issue or a QIP has been utilized, particulars of any major loan taken, the subsidiaries of the company, the employee stock exchange program, etc. The second report, and a very critical one for investors, is the corporate governance report. To put it simply, corporate governance is a system of rules and processes that are designed to balance the interests of multiple stakeholders, such as the shareholders, the management, customers, suppliers, the government, etc. Now, within the corporate governance report, the first section one should focus on relates to the board of directors. And as an investor, one would want to know how many of them are owning shares in the company, is there any conflict of interest possibility, and of course, the skills and competencies of the board members in areas like finance, compliance, operations, etc. The corporate governance report will also offer details on a number of committees, and in my opinion, investors should pay special attention to two such committees. The first is the audit committee, which works with the company's auditors to ensure that the financial reporting process and the company's financial statements are accurate, sufficient, and credible. It's an important role, and a large part of their work is to monitor and raise red flags in case they find situations like the sales number not being in line with the company's purchases or inventory, or if the revenue is being recognized in a non-standardized manner, a bit like what we saw with Byju's, or if financial reporting is not being done as per the defined policies, like how depreciation is being calculated or how certain expenses are being capitalized, etc. Needless to say, this committee should include only non-executive and to the extent possible, only independent directors to oversee the process. The second committee of note is the Nomination and Remuneration Committee, which firstly formulates the policy for identifying people who qualify for directorship or senior management positions within the company. And secondly, this committee also defines the rules of compensation. Again, this is an important one because greed and a little unfairness is everywhere. As a matter of fact, we saw a case of excessive compensation in the case of Sun TV Networks, where the two executive directors, Kalanithy Maran and Kaveri Kalanithy, drew a compensation of 87.5 crores each in FY21, which was 57% of the entire company's wage bill. Understandably, the CEO or an executive director should not be a part of this committee, and ideally all committee members should be independent. The third statutory report is the Independent Auditor's Report, which is also called the CARO report. This report is an official opinion issued by an external auditor as to the quality and accuracy of the financial statements prepared by the company. It's a document where the auditor is declaring to us, the shareholders, things like if the fixed asset is verified or not, that is, the plants and buildings that have been reported in the balance sheet actually exists or not. The auditor also declares that a count of the inventory has been done and the value has been assessed. They also check if the company is paying suppliers their dues, or if the company is paying salaries to employees and depositing provident fund, etc. I hope you can appreciate how important this auditor's report is. And sometimes I actually come across some reports where the auditor has given some soft red flags, something like the company said they are doing XYZ, but from what I can see, they are doing WXY. Now, even small bullet points like these can give us a view on the moral fiber and trustworthiness of the management. So always make it a point to read all the notes pertaining to Annexure A and Annexure B in the annual report. And the fourth critical consideration pertains to related party transactions. So a related party transaction, or RPT, is a transaction between two parties who are joined by a special relationship prior to the transaction. This can be something the company does for, say, the relative of the CEO, or an agreement between two companies that have a common promoter, or even a sale purchase transaction between the parent company and its subsidiary or a joint venture partner. Now, every company is required to give details of any transaction done with a related party, but truth be told, RPTs have always been a gray area. And while everyone seems to be defining RPTs in their own way, in my view, it's a lot about applying common sense. For example, if 20% of the company's sales revenue is coming from a related party, or if it is buying 50% of its raw materials from it, then that definitely qualifies as a related party transaction. And as an investor, one should be a little skeptical about the arm's length nature of the transaction. Alright, so this concludes the qualitative aspect of an annual report, and if you want to test it out, then do pick any company's annual report and go through the sections that I have discussed so far. And let me know what you learned in the comments box below. Alright, the annual report's fourth and final chunk is the financial information part, which can be further broken down into 4 compartments. The first is the balance sheet, which is a list of what the company owns, that is the assets, and what it owes to others, which is the liabilities and the shareholders' equity. The second financial report is the profit and loss statement, which explains the economics of running the business in terms of sales, expenses, and profits. Now, I strongly suggest that when you are working with the P&L statement, then try to examine it not just on an item-on-item basis, but also look at it across the last 4-5 years to get a better hang of the company's operations and how it is developing. The third financial statement pertains to the cash flow, and the cash flow statement explains how well a company is managing its cash position in terms of generating cash for its operations, paying off its debt, funding its operating expenses, the sharing of dividend with its shareholders, and having enough to fund its growth and working capital expenditure. And the fourth and final priority, and an area that is mostly ignored by investors, are the notes to financial statements. This is where the real information is, and these notes cover just about every financial area in details. Things like the accounting policies of the company, how it values inventory and intangible assets. Like in the case of DMart, is the revenue reported as per the MRP of the product, or is it calculated at the price at which DMart is selling the product? Specifics of property, plant and buildings, and the investments made by the company in listed or unlisted entities, including its subsidiaries, tax liabilities, shareholder information, etc. These are all important considerations, and the more an investor tries to understand them, the greater would be the assimilation and one can see the patterns better. Couple more things before we conclude this part. One, although the annual report will give standalone and consolidated financial information, please go for the consolidated statements as it looks at the company's financial performance as a whole, including the associate companies, subsidiaries, and joint ventures. And secondly, never forget to check the contingent liabilities of the company, that is, those potential liabilities that may occur in the future. This can be something like a pending lawsuit or product warranties or a tax liability that may hit the company in the future, and in most cases, no provision has been provided for. For example, DMart has declared contingent liabilities to the extent of 28 crores entirely on account of tax claims. So as a percentage of the company's net worth, this is a very small number. But say this number was 30% or even 20%, then a claim like this can land the company in a big soup, not just financially, but can also do serious harm to the reputation of the company. So this contingent liability part is something investors should definitely look out for when examining an annual report. Okay, so reading an annual report is not easy, and if you didn't know that earlier, then I think this video would have convinced you of how challenging the process is. But here's how I do it. Step 1, I download the annual reports PDF version from the company's website, and I use the application's yellow highlighter to shade only those parts which I find interesting and relevant. Step 2 is where I set a time limit of exactly 100 minutes. I use the first 45 minutes to cover sections 1, 2, and 3, that is, the corporate information, the management communication, and the statutory reports. And after a quick break, I spend the last 45 minutes going through the financials. And the last step, step 3, is where I try to answer some key strategic questions based on what I have already read for the last 100 minutes. For this, I follow a standard template of questions, a copy of which you can access in this video's description. These questions are quite varied, and by the time I'm done answering them, I get a wonderful snapshot and a relevant understanding of the company. So there will be questions like, what are the management's plans to take the business forward? And my short and crisp answer would try to explain that in terms of whether the company is expanding its capacity, or is it introducing new products, or is it reaching out to newer markets. Similarly, I will try to answer questions on risk, on conflict of interest, on financial parameters like sales growth, margins, cash flow, debt, etc. Which segments are growing faster than others? Where are the earnings going to come from? Did the auditor give a clean bill of health to the company? Whether the management is keen to reward shareholders, etc. So this is how I read and analyze annual reports, and the more one does it, the easier it becomes. And if you want to get into the habit of this, then I suggest you pick 2 companies from the same industry and implement the 3 steps that I just mentioned. Believe me, by the time you're done with those 2 companies, you will have that added advantage of knowing a lot about that particular sector as well. So I'm leaving you with some homework here, and I hope you enjoy it. Once again, please subscribe to my channel, do like this video, and I'll see you 3 days from now. Until then.